Hello, ladies and gentlemen. It's Modern Investing on Pod TV. My name is Sasha Star, and today's guests are Dr. Milan Somberg. Welcome to the show, Milan.
Thank you for inviting me. Delighted and a pleasure.
Thank you. And Jim Eid from Eid Foundation. Welcome to the show, Jim.
Thank you for having me, Sasha. I appreciate it.
Okay, so how was the last week from your point of view, Jim? What have you done? What have you failed to do, and how it all works out?
Well, I think this week was generally speaking good. There seems to be the confidence in the market it has been restored, and I think the Fed has given some signals of easing off on the rate hikes, and even globally, although the rate hikes globally still are happening, there seems to be some indication that they might be easing the hikes in response to inflation. Of course, I never thought that they should have been related, but the idea of further hikes would spook the market, and the idea that they won't be happening has caused this sense of relief, and this relief is being reflected in people buying, which is raising prices overall. And it's been generally good to be in the market. If you're in the S&P, as Milan has been telling us to be, I think the S&P is higher than it's been in quite some time. And I think the overall positive sentiment is good and warranted. I think the economy in the United States is doing quite well, despite the constant warnings of a recession just around the corner.
Excellent. Okay, Milan, it's your turn now. Please tell us.
Well, how important is investor sentiment in predicting stock prices? We tell our members, the Monday Morning Millionaire members, we have about 300, we tell them to look at predictions and forecasts for amusement only. There are some exceptions, though. You know, Daniel Kahneman in 2002 was the winner of the Nobel Memorial Prize in Economic Sciences. And he's not an economist, he's a psychologist. And he won the award because he claimed that investor sentiment is more important in determining stock prices than financial statements and various ratios. So given that, how can we gauge investor sentiment? Well, the put-call ratio does that very well. So if we take a look at the put-call ratio, which is a ratio between all put options and call options that have been purchased on any given day, and it describes investor sentiment, which Kahneman suggests we look at carefully. And today is strongly positive, as it has been actually for quite a while. So the thing to do, we talk about writing derivatives, selling covered calls and cash secured puts. Selling covered calls does not work as well as just simply owning the underlying security outright in a rising market. In a rising market, we are a lot better off holding off the security, and we recommend SPY, which describes the American economy as a whole. We recommend that as being safe. And not writing covered calls on it in a rising market, which we have right now. So people, and myself included, simply holding SPY in our portfolio entirely. I don't own anything else. Actually, I have a fund portfolio. I don't know if I want to waste our time talking about it, but I've done well simply because the market has done well. And the put-call ratio remains positive, and in the short term, it's fairly reliable as an indicator of investor sentiment, and it remains positive. So the thing to do is hold your underlying security, count your blessings, and enjoy your increasing wealth.
Well, Milan, explain to me what the put call ratio is. You have puts,
and
too
call.
many more puts than calls. That's positive, or vice
Well,
versa.
people who buy these things, and we talked to our members never to buy derivatives, only sell them. But people buy them, and why do they buy them? They get enormous leverage. Say, for instance, if you're going to buy 100 shares of SPY, you'll need close to $45,000. You can get the same benefit of any rise in that security by buying call for a couple $100.
Mhm.
If the security does not go up, which in the short term, say a week or so, happens half the time, you lose your money entirely, 100% loss. So but it's only a small amount of money that you're losing, or at least it should be. So the puts represent the negative feeling that people have about the market direction, and the calls, people who buy calls hope that it will rise, so their view is a positive one. So when you compare the number of puts, take a look at the volume of puts and open interest, and compare that to the calls volume and open interest. And you can do that on any individual security, or you can do that on the whole market by looking at SPY. You can see that there are a lot more, there's a lot more volume and open interest today on SPY, tomorrow similarly, and the day after that also. So I'm just looking at 1 week out because we recommend doing our selling on a Monday, expiry date on a Friday. So we look at a week out, and the ratio of calls, people who are hoping the market will go up, is much larger than the ratio of puts, people who are hoping that the market will drop.
But I find it interesting that, you know, the ratio that sends a signal that it's positive is people buying calls. But you advise against that. Is that, am I accurate?
We advise against buying calls because in a week out, half the time you will lose your money entirely.
Right.
In a week period. You can buy calls a year out, and you could make money with that. And I think that Warren Buffett has been doing that. Some calls you can buy several years out in the hope that they will rise, and that often happens, of course. But when we talk about a week, you know, the shorter the time frame between the selling and the expiry date, the greater the return, the greater the percentage return, not the amount, but the percentage return. So we recommend our members that they sell covered calls or cash secured puts on a Monday, expiry date on a Friday to get the best returns there.
I'm just pointing out the irony that if people followed your advice, which seems to me to be good advice, they wouldn't be sending a positive signal. They wouldn't be buying these calls, which is the ratio that you say indicates investor sentiment well, and would indicate a positive investor sentiment. But if they follow your strategy, they wouldn't be signaling a positive investment
If
sentiment.
they follow my strategy, they wouldn't be buying derivatives, only selling them.
Right.
Now, whenever you buy any security, you're buying it for somebody who's selling it. Only one can be correct.
That's right.
So we recommend that we only sell derivatives, and the people who are buying them will be in the wrong.
Yeah.
But I have a question, just a moment, Jim. I have a question, Milan, to you, that if there is an enormous activity in calls versus puts, let's think about it.
Yeah.
So if there is a million people who are buying calls, thinking about rising market, and there are another million people who are selling them calls, because you cannot buy calls if nobody sells. So there are a million buyers and million sellers.
I see what you're at, and your question is a good one, Sasha. But you also have to look at open interest, and open interest has not been completed. Those are market orders which have not been filled.
Right.
That's the only thing what we can analyze. There is nothing else
Yeah,
to.
okay, yeah, that's okay. You can do that. Just look at
Yeah.
the open interest.
Okay, so open interest, let's say 1,000,000 contracts, for example, an open interest.
Okay.
So it means 1,000,000 people, not for just to simplify the situation. 1,000,000 people purchased the calls, and 1,000,000 people sold the calls.
No, that's happened. That is volume. Open interest has not been completed yet. So there could be a much larger number of either sellers of puts or buyers of puts or buyers of calls. Those numbers don't have to match in the open interest aspect of things.
No,
In
no,
the,
no.
in the volume, yes, for
Well,
every.
Milan, let's clarify what is an open interest, so we all understand
Okay.
that we are talking about the same
Open
thing.
interest is orders which have been placed but not completed. Not
That's, in your opinion, is open interest?
That's what, under my opinion, that's a fact. I have opinions which are wrong much of the time, but facts are facts.
Wait a sec. In my opinion, open interest is contracts which already been fulfilled, because no, there is no such thing as open interest in unfulfilled contracts, because the moment you put a bid to buy a call or a put, it will be filled in a matter of 10 seconds, maybe even much faster. So there's no such thing as unfulfilled orders. I mean, the order filled. I mean, if you make ridiculous of order, let's see the call on SSPY, for example, say it cost $5, say November expiration date. You put bid at $3.25. That order will not be fulfilled. So you believe that there is an open interest of orders that are hanging in there and are not filled for obvious reasons because they're well below the existing price. And you're talking about that interest?
Maybe, and you're quite right about how quickly orders get filled, but until they're
Instantly.
filled, they fall under the column of open interest. Once they're filled, you're looking at volume. And when you look at volume, then for every sale, there's a buy. For every buyer, there's a seller. They equal. But in open interest, they are hardly ever equal.
But isn't there institutional buying as well? So you could place an order and the institutions buy it because they're just making the market.
Market makers are buying and selling calls and pools. Okay,
Right.
so there's no doubt about that. So if it's any reasonable order to buy or sell something,
That's why it gets filled.
it will be filled instantly. Now, if it's unreasonable order, so what's if you're right, Milan, let's think about something. What for us is indication if there are 1,000,000 orders to buy calls at way below the market price, and whether there is an open interest, as you call it, 100,000 or 1,000,000 or 10,000,000, what does it tell us? How we can make any decision?
It simply talks about investor sentiment. That's what it tells us. So if the orders are not filled because the price which people want to have them filled at is out of line, say if somebody wants to buy, these are buyers, they're almost always wrong. Much of the time, if somebody wants to buy something which is way below market price or significantly below market price, it's not going to get filled. That order is not going to get filled, and that remains a part of open interest.
But in this case, it's very, very suspectful of market manipulation, because let's see, if a call option is selling at $5 and I will put 10 million order of 10 million for $1.25. It's not going to be filled, but it falls into open interest according to you.
Right, that's right. Yeah.
So then people say, "Oh my God, there is a 10 million open interest," and then I believe that the sentiment is bullish, let's go and buy all stocks in S&P 500 and have this
That's
account.
right.
It doesn't make a lot of sense to me.
If they're buying calls, they have a bullish sentiment. If
They're not buying, they're putting misleading prices to
okay,
do.
yeah. If they're placing orders, which are not filled because the price that they're asking for is out of line, then it becomes a part of open interest, and they have a bullish attitude, which it describes investor sentiment, which is so important in pricing securities. Investor sentiment is more important, according to Daniel Kahneman, than financial statement entries and various ratios such as price earnings ratio and so on.
Sasha, maybe I can ask you a question. How would you determine public sentiment then? If this is not satisfactory to you, or it can be manipulated to you?
Good question. Yeah.
How would you decide it? How would you determine whether or not the market is like I described it in the opening as I think it's positive right now. I think the market sentiment is positive. That is just based on the various data that I collect and my judgment. But do you have a more rational, more numerical kind of way?
Just before we continue, let me read something to you.
Sure.
What is open interest on options? The total number of outstanding derivative contracts, such as options or futures, that have not been settled for an asset. Okay?
Exactly.
That's exactly what it is. Okay. So then we can talk about that this is, in my opinion, easily manipulated figure.
The market manipulation is happening all the time.
Exactly, and that's the easiest one, because there are market manipulations, but to manipulate the market, for example, in penny stocks, you have to come up with a certain buying, so to show, as it used to be called, paint the tape. But painting the tape requires some money. You cannot paint the tape without money. Now, here, you don't need any money. In fact, okay, where goes your order? Let's see, the option cost $5. So you put a bid at $4.95 with great expectations to be filled. But you can put order at $1.25, which is not going to be filled forever.
That's right.
So therefore, you can put order, and because all the orders buy and sell go into the market maker, each option is assigned to a market maker who buys and sells on his own account or account of his company and so on. Like Goldman Sachs is obviously a big market maker and many others. So in order, the market maker himself could put an order to buy at $1.25 option, which costs $5, and it is part of an open.
I mentioned earlier, and I keep mentioning, that more crime is committed on Wall Street before noon than any other place in a decade.
But okay, this market makers, okay, they can do whatever they want, Milan, but it's important that you and your subscribers believe that they're getting valuable information that can affect their investment decisions from that number of open interest. Right. And that could be highly misleading, if not manipulated. So how you can base your investment decisions on such a information?
So the put-call ratio, is it trustworthy, is the question I think Sasha is asking you.
Yeah. Well, you're right. You're quite right about it may not be trustworthy. Why? Because it comes from Wall Street. And Sasha, like James asked you, what would you use to gauge market sentiment? Do you have a reliable way yourself?
Only the tape, the market prices. That's the same thing what Jesse Livermore did 125 years ago. That's the only thing what tells you anything. It's price action and volume action. That's all what you can rely upon. That is reliable.
Listen, Sasha. Jesse Livermore committed suicide.
It doesn't matter.
He's a lousy investor, so you kind of follow him.
He was highly successful tape reader probably the best of his time, and not only his time, but much beyond that. It doesn't matter that he passed away. Well, you know what? Mozart has been ended his life in a cemetery for common people, and only 3 people attended his funeral. His legacy is, if you're talking about materialistic side of it, he left his wife 3 shillings, and he owed his doctor 20 shillings. So he was absolutely destitute. But think about this. He had several concerts a year, and for one concert, he was paid as much as his servant would make in 15 years. Plus, he was composing, and he was paid for his all his works and so on. So it doesn't matter. So you're comparing Jesse Livermore to Mozart? That's fine. Look, it doesn't say anything.
Again, to get back to the what you're saying in response to the put call ratio being an indicator, you're saying that if you're seeing green on your portfolio, then the sentiment is positive, and especially if the volume is high.
You're asking me?
Yes.
Yes, that and volume. You
Right.
always have to, if this stock goes, let's see, the easiest one probably is NVIDIA. If NVIDIA moves every day $25 a share, and there is a volume that supports, because without volume, you may think that maybe it's manipulation, and maybe it's
right.
He's trying to jack up the prices or so on. But he cannot create enormous volumes. We're talking about 20 plus million of shares a day. Okay, so this tape action is superior, in my opinion, to anything else. I don't care even to look at their balance sheet and the profit margins and so on. I'm not interested in that. I'd rather read something interesting.
For me, what I would do is take the put call ratio over time and see if it tracks the market, and whether it tracks the sentiment of the market as best we can determine it. And the way I track market sentiment is, what you're reading in the press and what you're hearing. And this kind of thing is like you hear these things. And I always say, I'm a contrarian, because when I'm hearing everybody is bullish, then I'm going, whoa, I'm reining it in. When I hear everybody is bearish, I'm looking for the buying opportunities.
And you hear that by reading the papers. Yeah. Well, now it's been said, and it sure makes a lot of sense, is buy on rumor, sell on news. Because by the time it gets into the papers, the knowledgeable people, the insiders,
have already been,
Now, interestingly, talking about crime on Wall Street, I was speaking with some friends yesterday, and I mentioned how it used to be illegal for you and me to trade on insider information unless we were members of Congress. That's no longer true. And my friend, who is a serious investor, said it now is true again. If you're a member of Congress and you commit a behavior which would send you and me to jail, you're okay. So, you
live in interesting times.
But I would like to mention something, that unless you're a member of Congress, there is no such thing today as insiders information, because everything is open. All sources are on internet. Everything that you want to know about the company. And I don't understand, why would you need to know anything about the company? Because the tape shows everything. You don't need to listen to it.
Before it gets to the tape, insiders know that they're going to find oil, or they have found oil. Insiders know that they're encountering difficulties before that becomes not sufficiently knowledgeable for all of us to know about.
Okay, that's insiders information in most of the cases. But how you, me, or Jim can find out about it? We
can't. That's
the only thing is we can watch the company announcement, and we can watch the tape. And I'm telling you how many times insiders were wrong. Do you know how many insiders were selling, for example, Netflix or NVIDIA shares 5 months ago, 4 months ago, 3 months ago, and 2 months ago? So they are insiders. They're supposed to know what great companies are.
a friend of mine whose father started a business some 70 years ago, a ski resort, a very successful ski resort, just sold it recently. And through the business, they were connected to some very high-ranking executives at Toronto Dominion Bank. And one of these high-ranking executives suggested that he buy Nortel when he had dropped 50%. Nortel used to trade at $120. When he got to 60, TD Bank executive suggested to him, now it's time to buy Nortel. And Nortel dropped to below $1. So
There's another illustration of what I'm just saying for the last
it is.
7 or 8 minutes.
He's agreeing with
You
you.
have to watch the tape. The problem is that most people don't know how to watch the tape. They're lazy to learn how to do it and how to read it properly. And so therefore they're relying on all kind of...
I'm just overjoyed that I heard paint the tape. I haven't heard that in a long time.
It's a different thing. It was...
Yeah, I know.
Yeah, at the time of
But it's
Jesse
been a long
Lee,
time since anyone said that.
have you heard the expression pump and dump?
Pump
Yes.
and dump. Yep.
Yeah. And so people who pump and dump are pumping up by placing buy orders with one broker and selling the same security with another broker and getting out profitably while you and I are getting hurt. I mean, the number of questionable activities that are happening on Wall Street, the list is very long. For example, hidden fees. You know that now you can place orders and not pay a commission at all. And,
Yes.
and yet the executives of the Wall Street banks are making millions of dollars.
I could tell you one thing I fell for, Milan. It was I bought this in mutual fund that had no initial fee, and I thought that's great.
Happens, yeah.
And it turns out they had what's called an inside load. So when they were trading inside the mutual funds, they were charging me a fee every trade. And so when they paid me out, it was all deducted. So what I got was a fraction of what I expected to get. If they had charged me an initial load, the initial fee, I would have been, the same, or maybe even a little better off if they had done that. So this inside load was just fooled me until I got onto it.
I have a list of hidden fees over here, and that inside load isn't there, so I should add that to there because also you might have been facing, many investors do, back-end load. Yeah. When you go to sell, they charge you then. By hidden fees, investment advisory fees, purchase fees, redemption fees, exchange fees, management fees, account fees, distribution and services fee, transaction costs, which are now nothing, front-end load, back-end load, plus what you mentioned here. The list is very long, and the large print gives and the small print takes away.
Oh, that's for sure.
And they're required to publish this information because the SEC requires them to publish it, but it doesn't have to be.
I didn't read it. Yeah, I didn't read the small print, and I got fooled.
Yeah.
Okay, now we know what it is. Well, let's talk a little bit about the market action. So against all beliefs, the market leaders such as Netflix, the NVIDIA, Microsoft, they are, I would add also stock CRM, which I have some position there. They're all doing wonderful job. And sometimes I'm questioning myself, why do I need anything else besides these 3-4 stocks? And I don't have an answer to that. Unfortunately, I do have a couple of other, but relatively small positions. I have Palantir, for example. I have AMD, Advanced Micro Devices. I have the AbbVie, ABBV symbol.
Yeah.
And I'm questioning, why am I distracting myself from the real market leaders? It's so obvious. The only reason that I can justify that I still hold on to it, because in some of these positions I sold covered calls, so I'm waiting for them to expire. Hopefully they will expire pretty soon. One is, I think, AbbVie expiring August 11th, and CRM expires August 4th, if I'm correct. And that's it. And then from that point, I'm free to fully participate in this market leaders. And they are wonderful. And you remember, Jim, when I called NVIDIA this year 500?
Yeah, I do.
Well, how far
Well,
are we?
I mentioned earlier, Sasha, you are a market wizard. The market
Oh,
wizard, what you talk about, that be you, because you know that the average investor trails the market by 40%.
Yeah,
And
unfortunately, everybody thinks that they're a market wizard, but there aren't
Yeah.
that many of them.
yeah, and Sasha might well be one because the results you're getting strongly suggest that you are a market wizard.
Well, one of the things I keep saying, Milan, is that you follow your rules and be disciplined about it, and have rules and follow your plan.
Yeah.
And whether it's what you're advising, which is invest in the broader market, or what Sasha is inviting is use your intelligence and experience to pick certain stocks and to concentrate on those. Whatever it is, I think if you stick to your plan and you don't keep changing in midstream, and you don't fall for the I heard this on the news, therefore I'm buying, and getting in a hot advice, a hot tip from somebody. As long as you're not playing that kind of nonsense, and just being
Right on.
disciplined in the market, you're going to do okay, because the
Right on, Jim.
market has been rewarding us for a long time.
Yeah.
Right on. You're right on with that. And we recommend, as you know, security that represents the S&P 500,
Right.
Which represents the American economy as a whole. We recommend that, and of these exchange-traded funds, that there are more exchange-traded funds now than individual securities out there, but only about half a dozen of them track the S&P 500. And SPY is the best because it's the oldest, the largest, and has the smallest bid-ask spread, which is a cost that most investors ignore. You're buying the American economy, which has been the strongest economy for over 100 years and likely to remain so for quite a while yet. And yes, empires have 100% failure rate. That's true. But the failure of the American empire is not visible anywhere yet. When you take a look at all the money that's going into the United States, you know that it's a strong economy. The 15th century belonged to Portugal, the 16th century belonged to Spain, 17th century belonged to Holland. Small country like Holland,
I know, but they're seafarers, though.
Yeah, 17th century belonged to France, and they still think it does. And so the 19th century belonged to Britain.
Yeah, the sun never set on the British Empire.
That's right. And the 20th century belonged to the United States, but we are now in the 21st century. Will China take over?
Yeah. And the fast rising power that might be India. Who knows? I mean, these are interesting topics to explore. China is already the second leading economy. And Japan, at the end of the 20th century, we were thinking Japan was going to be the power.
That's right. Yeah.
And they were buying all of our real estate, and we were all scared. And these things can change, and it's very difficult. And I think there's signs, anyways, that there's going to be some more cooperation between China and the United States, because they're finding out they're in it together. If one of them keeps polluting the planet, everybody dies, and so they've got to work together to solve some of these problems. And so there's going to be competition, always is, but there's also going to be some cooperation and collaboration that might be beneficial for the entire world. But
there's one thing that we can learn from the Chinese. Actually, there are two things. One of them is they drink their soup instead of using spoons. So we can get that from the Chinese. But another thing that we can from the Chinese is that the higher up they go in government, the more qualified they need to be. They have to pass civil service exams that become increasingly more rigorous as they go higher up in government. And in the United States and Canada and much of the Western world, anybody can get elected. People with no education, people with an IQ that's below 100 can get elected. And there are many examples of that. And certainly the founders of democracy, the ancient Greeks, Socrates, I think, would be a good example, would be aghast to see the way that democracy is run today. Except in China, where they don't have democracy, I guess you have to say that. But the higher you go in government, the more qualified you need to be. You need no qualifications in the United States. You need
Milan, it's a two-way street. If a country can elect somebody with IQ below 100, it means that most of the electorate is well below 100. So eventually, at the end of the day, people deserve their leaders. They're electing a leader.
There's so much truth to that, sadly.
Yeah.
But we wouldn't have it any other way.
We deserve the government we have. Yeah.
Well, with that, I would like to thank you very much for today's program, and good luck in your investment, trading, and we'll see you next Wednesday, same time, same place. Thank you so much.
Good to see you.
Bye-bye.
Thank you. Thanks. Bye-bye.